Hey, welcome back. My name is James Johnson. My expertise lies in retirement and estate planning. I've been in this business since about 2003. And what I want to talk to you today about is wealth transfers and how people transfer money unknowingly and unnecessarily out of their house. And more specifically, we're going to talk about wealth transfers when it comes to how you pay for your house. Now, it's important to understand that you have three types of money. You have what's called accumulated money. That's all of your assets. That's your stocks, your bonds, your mutual funds, your certificates of disappointment, your annuities, 401ks, IRAs, your house, etc. These are all the assets that you've managed to accumulate in your lifetime. Then down over here, we have what are called lifestyle money. And this is the money that you live on. And if you were to ask me, I would tell you you're supposed to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. And so what we don't want to be doing when it comes to our planning is figuring out how to cut our lifestyle. We want to keep our lifestyle as much as it is today and increase it with inflation going forward. And we want to live the lifestyle we've become accustomed to, adjusted for inflation and taxes, and not outlive our money out beyond our life expectancy. So the third type of money we have, and that's our transferred money. And our transferred money this is the money that most people are transferring unknowingly and unnecessarily. Now, if I can find money that you're transferring out of your life unknowingly and unnecessarily, will you save it? So as I said, people transfer money in 6 major areas. They transfer it in how they pay for their mortgages, how they fund their qualified plans, how they fund college funding, how they pay their taxes, protection, and major purchases. So today, we're going to focus only on how you're paying for your mortgage, and more specifically about those people that are making extra principal payments towards their mortgage. Now, what we have here is what we call the personal economic model. And the personal economic model, if you don't understand it, I would highly recommend you go watch one of the videos on exactly how it works. But I'll give you a brief description. Over here to the left, we have a large tank, which is where all of our money flows in. And then our money either bypasses our tax filter by going into this tank over here, risk and tax deferred, or hits the tax filter and gets pumped up these pipes into either into what we call the yellow tank, which is our risk tank, or into the safe tank, which is our green tank. Then over here, we have mortgages and we have our house. So this top line up here represents our risk tank. And our risk tank is 8% is the rate of return that we're going to use as an average. And then our safe tank, we're going to use 5% as an average. On our loan tank, we're going to use 4%. And right now, for this moment, we're not going to show appreciation on the house to keep our mathematics simple. Over here to the right, we have a 360-month loan or a 30-year loan, and we're making an extra principal payment of $1,000. Now, if you're one of those very literal people going, well, you're never going to make 8%, you're not going to make 5%, forget all that for a second. Just follow the concept. We can go change the math at any time to whatever the number you want to make it be, and you'll find out that the ultimate outcome will be very much the same, and that you probably still don't want to be doing what you think you should be doing. So if we look here and we make this $1,000 extra payment towards the house payment on this house at 4% would be $1,910. But if we're making $2,910 payment towards this house, by 185 months, our house will be completely paid off. Now, if we're listening to the Dave Ramseys of the world, or the Susie Ormans, or the talking heads that talk about how we should pay off our house as fast as we possibly can, get out of debt as fast as we possibly can, well, we just accomplished that. We paid off our house. We made an extra $1,000 payment against it every month, and we are debt-free at 185 months. Well, there's this little thing called the Parkinson's Law. And the Parkinson's Law says your expenses will keep up with your income regardless of how much money you make. The more money you make, the more money you spend. And the thing to remember here is while we were making that extra principal payment, we didn't have a lot of money over in safety. So if we lost our job, suddenly we might not be able to make that house payment. But if we were to continue to go on here, the Parkinson's law is probably going to take over and our life is going to find a way to spend that money. So it'll come here, hit the tax filter, and it'll be consumed and gone forever. Now, I want you to notice that during that time, my house did not go up or down in value because all I did was make a house payment against it. The only way that a house goes up or down in value is 100% based on inflation or deflation. So the house is inflating as far as appreciating, or it's deflating based on depreciation, meaning the value of the house goes down. And no matter how much money I put in that house as far as house payments go, that house will still appreciate or depreciate at the same exact level. So therefore, the rate of return on equity is always zero. And if the rate of return on equity is zero, then that means that the equity in that house is actually losing money on two fronts. The value of that dollar is becoming less and less every single day going forward based on inflation and opportunity cost. If I had that money, I could invest it somewhere else. So let's see what happens if I actually invest that money somewhere else. So now rather than taking this $1,000 and giving it to the bank, I'm going to take this $1,000 and I'm going to start by putting it in my green tank, which is my safe tank. Now, if I do that, what you will see is that now I've got $1,910 going towards the mortgage and $1,000 going towards the safe tank every month. Well, I paid off my house in 8 months faster than I would have by paying the bank, because now over here I'm growing on my money, but much, much more importantly, I have this money here. Should I lose my job or have some major emergency come up, I can still be making my house payments from that account and not be risking my house, of which I was putting all that extra principal payments into, and I know how any liquidity. Now, the interesting part is if I keep making that for the 30 years, I'm going to end up paying off my house just like I would have before. But at the end of the time, I'll have $575,726 in my safe tank, and I'll have a house that's paid for. So I'll end up with $1,075,726 in assets, where I would have ended up with only $500,000 in assets. And all the way along the way, I had safety, liquidity, and rate of return. So I ended up with $575,000 more than I would have otherwise. So this time, I'm going to reroute that money, and I'm going to route that money over into the risk tank. So rather than going up here and hitting this diverter and going to the right, I'm going to hit the diverter and I'm going to go to the left. And you can see that when I do this, now I'm going to actually have enough money in my bucket to pay off my house in 158 months. 27 months faster than giving the money to the bank. 27 months faster than giving the money to the bank. And I can assure you that once you understand the math of this, when you get here and you have this $280,000, you're not going to transfer it to the bank. You're going to keep it working over here, because by keeping it working over here, by the time we get to the end of that 30-year period of time, we are going to end up with $1,165,047 in our risk tank and a house paid off. We're going to be at assets of $1,665,047, which means we've got $1.1 million, almost $1.2 million more than we had by paying the bank. Now, there are several ways that we could do this, and we don't always have to be putting our money all on the risk tank or all on the safe tank. As a matter of fact, if I was to ask you this question, if you could grow your money tax-free, access up to 85% of it at any time tax-free, put it back if you want, get most of the gains of the market, never participate in the losses, and when you die to pass on it 2 to 3 times that amount tax-free, would you want to do something like that? And I suspect the answer is yes. As a matter of fact, most people I ask that to say, well, how do I do that? And they want to put as much money as they possibly can in that environment because it's quite incredible. So I could actually use the safe tank and get similar returns to the risk tank and grow my money tax-free, pass it on tax-free, all of the above. So remember to live like you're going to die tomorrow and plan like you're going to live forever because you just might. Be sure to subscribe to our YouTube channel below, and I look forward to seeing you again soon. Keep smiling and make it a great day.